Okay, let's talk about monetary policy options. Money enters the economy by a process called money creation. Banks create money by making loans of money people deposit in the bank. So if a person deposits $1,000 in the bank can loan most of that money out to somebody else. That loan will eventually wind up in a bank account, and most of that money will be loaned out to another borrower. In this way, the original $1,000 deposit leads to the creation of hundreds of additional dollars in the economy. The Fed has three tools for adjusting the amount of money in the economy. The simplest is to change the reserve requirement ratio. That's the amount of each bank deposit that a bank must keep in reserve and not lend out to another borrower. Reducing the ratio means that banks can lend out more money, increasing the money supply. Increasing the ratio has the opposite effect. It would decrease the money supply because banks have to hold on to more of the cash. This tool is rarely used today. A second tool is to adjust the discount rate, which is the rate the Fed charges on loans to banks and other financial institutions. When the discount rate goes up or down, interest rates for other types of loans go up or down. For example, a drop in the discount rate would generally lower the prime rate, which is the interest rate banks charge their best customers. When banks lend money at a lower rate, it tends to increase the overall money supply. Today, the Fed generally does rely on changing the discount rate as part of its monetary policy. The discount rate had been at zero for a long time, and now it's inching its way back up as the Fed has decided that the economy is in good shape. The Fed's third and most commonly used monetary tool is the open market operations. That's the buying and selling of government securities, such as bonds. When the Fed wants to increase the money supply, it purchases securities. The bond seller deposits money from the sale into the bank. The bank loans that money out, and we have the money creation process. To decrease the money supply, the Fed sells the government securities. The money paid for the bond is taken out of circulation and held by the Fed, and therefore reserves are reduced. There's less money out in the economy. Open market operations tend to affect the federal funds rate, which is the interest rates banks charge each other on loans. Changes in the federal funds rate can also affect rates available to businesses and individuals. What is money creation? Which of the following is a basic tool the Fed can use to implement monetary policy? What would likely happen if the Fed raised reserve requirements? Why do the discount rate, federal funds rate, and prime rate have a limited impact on the long-term growth of the economy? What is a major concern about Fed policies that lower interest rates and increase lending?